Casual Friday, June the 2nd, 2023, for the latest edition of the Jack and Bill Show.
Are you sick?
No.
Oh.
No, I have lost my voice because
Yelling at Wesley?
I'm overcoming bronchitis that I picked up in New York City, I think, 2 weeks ago.
A little too close to a rat.
Yeah. So, well, Bill, the market is making a rally here to close out the week. In fact, it's interesting because we've had, all this hype about the debt ceiling, and then it's pretty much played out as we thought that it would. As soon as the market started getting volatile, both sides came together and did something irresponsible.
Well, I mean, it's nothing more than political theater. And we see this every few years.
Yeah, so what we've had in the last 2 days, I think the president is signing that into law today. Went through the House earlier in the week, the Senate overwhelmingly yesterday. And that in combination with the jobs number that came out today. I think the highest estimate for May jobs was, a forecast for 195,000 new jobs. And that was the highest estimate. We came in at 339,000. However, the unemployment rate climbed from 3.4 to 3.7%. Full employment is considered 5% unemployment. So we've got the bond market yields higher on the short end today, and the stock market is up sharply, with the Dow Jones Industrial Average leading the way. Bill, the Dow is up nearly 2 percentage points today, just today. But that brings up an interesting point to me. That is the NASDAQ market intraday year to date is up. I just looked, 33.1%, and I think the Dow Jones Industrial Average busted into positive territory this week.
Well, when people say the market is up, they're commonly referring to the major index, which is the S&P 500. And yes, the S&P 500 has done well year to date, not as well as the NASDAQ, but we know the drivers of the index performance, and that is big tech.
Yeah, that's where I was going with that. We've got, here you go, Amazon, Apple, Google, Microsoft, Meta, Tesla. Tesla's up nearly 5% today. NVIDIA and Broadcom. If you just own those names, you're up over 50% this year.
I mean, you could even drill down further and you could pick out two stocks, Apple and Microsoft, call them the Nifty 2. Those two stocks alone, aren't they comprising about 30% of the returns of the index? Or is it 30% of the market? One of the two. It's huge.
Well, I rattled off 8 names, but those 7 names comprise 46% of the market cap of the Qs, essentially, of the NASDAQ market. So, and then it would be what percentage of the S&P 500? A large percentage.
Anyway.
So the S&P 500 up 10.7% year to date, and this is going to bring up this interesting battle or tug of war of within the analyst community of what the Fed's doing. The consensus right now is that we just got a 1/4 point hike May 3rd, May 3-4 when they met earlier last month. We're now into June. So the next meeting is June 13 and 14. We're probably going to see a pause, but it's data dependent. I happen to think that there's more work to be done, but it's going to be completely dependent upon how the economy's doing and whether or not the inflationary numbers, CPI and PPI, are coming down. So today, with industrials, Dow Jones Industrials leading the way with this jobs number is, that's a good thing. I mean, we've had all this talk that we're headed into recession, and yet we're still seeing, headlines every day about layoffs in tech, layoffs in financial services, the banking industry. Yet we see this jobs number that's still, very strong. So,
well, I think that's a good transition, a good segue, because that's what we want to discuss today is recession, because that has been the talk for months. Are we heading into recession? So I'll put the question to you. What is a recession?
Well, I think most people like to define a recession as 2 declining quarters in a row of gross domestic product. I mean, I think that's
it's a technical definition.
Yeah. So
and what is gross domestic product for the benefit of our viewers who are not familiar with that?
It's really domestically the multiplication of sum total aggregate goods and services sales in whatever period you're addressing.
Right.
So
it's the quantification of the health of the economy, to put it in simple terms.
Yeah.
And so when we see back-to-back declines in gross domestic product, that's indicative of a contraction. And we have this ebb and flow over time, and that's normal. And so we go through periods of growth, accelerated growth, peaking, and then slowing down and contraction. And in that trough, we go into recession. And it's normal and it's healthy, because without that, things would just go to the moon. And with that come other problems. But that's how it's supposed to work normally. But we do have situations where the Federal Reserve Bank likes to involve themselves, and that kind of monkeys with the system. So that's what a recession is, and why they occur. Well, it's just a natural occurring phenomenon. And so things get overheated, and then things need to slow down.
Yeah, in 2021, our gross domestic product was $23.32 trillion US dollars. So, and then we grew from that last year at a roughly a 2.5% clip, something like that. So our economy right now is right around. Probably this year we're going to be around between 24 and 25 trillion dollars. It's interesting, Bill, because a lot of people like to compare our national debt to the GDP as well, kind of wandering out here in the weeds. But our national debt is now 31 trillion, something like that. So our debt to GDP is well over 100%.
Yeah, I mean, and that is something to be concerned about. It's something that we've talked about many times in past episodes. Here's another take on that: is look at the debt servicing costs as a percentage of our economy, as a percentage of our budget. It's actually okay, and I think we've benefited from low interest rates. Debt service as a percentage was much higher in the early 80s than it is today. But that's talk for another day.
Yeah, another thing to point out though, I was reading this earlier this week. With inflation running at 5%, our debt is really shrinking. If you think about that,
right.
Some people, I think, conspiracy theorists and others would surmise that it's been intentional for the Federal Reserve or the U.S. government to be behind with monetary policy to thwart inflation, because if we had double-digit inflation, it would have the effect of cutting our debt in half in at 10% in every 7 years. So anyway,
so inflation, it's an economic phenomenon. We're not or recession, I should say. Recession's an economic phenomenon. We're not in the economic business. We're not paid to make economic forecasts and provide economic predictions. That's not what we do. We manage money. So then the question is, how is this relevant to investing? Would you like to take a stab at that?
Okay, how is what relative to investing?
How is the economy, the health of the economy, and where we are in the economic cycle relevant to investing?
Well, I think that the first thing that I would say, you can't really apply. We study history, but there aren't any hard and fast rules that you can apply to even economics. It's a social science. It's not an exact science. So here's the deal. If we go from World War II, if we go all the way back to World War II, there's been 13 tightening cycles, either 13 or 14, I forget. And 10 of them ended in recession. So that's about a 70%. So you would say...
Now, let me stop you. When you say tightening cycles,
yeah.
So we're talking about the Federal Reserve Bank raising short-term interest rates, the Fed funds rate, like they're doing currently.
Correct. Now, this happens to be one of the more dramatic tightening cycles. I mean, we've had 10 meetings in a row. The Federal Open Market Committee meets every 6 weeks. So every 6 weeks for the last, going back 10 meetings, they have hiked. And a number of those meetings were 3/4 point, hikes, large hikes.
Yeah, when you plot this cycle to historical rate hiking cycles, this is the steepest.
Yeah. So if you study history, it would be probabilistically, I would say, with almost without a doubt, the Fed has to be taking us towards a recession. And that's because it's their goal to get the consumer price index numbers, back down to 2%. Although a lot of economists are thinking it's going to be a little bit stickier this time, and that if you go all the way back to 1926, CPI inflation has averaged about 3%. So you have to question why the Fed would have a 2% target, and are they going to raise the target to 3%? But to go back to your question, Bill, it's highly probable that we're going to be in recession, and so what impact does that have on investing? Well, a lot of people thought we would have been in recession a long time ago. For some people, it's usually backward-looking indicators that tell us that we were in a recession. Where we. So in the future, they'll look back and say, that. But that doesn't necessarily mean that the stock market has to decline.
Well, that's right.
And there's other markets beside the stock market. We're talking about, commodities markets, the bond markets, the stock markets. I mean, currencies and all these things.
Let's tie this together, because you mentioned indicators. So if we're trying to take a stab at where we are in the economic cycle and if recession is coming, how close are we? Well, there are indicators, economic indicators that we can look to help us in that analysis. And there's three broad categories. There's leading, lagging, and coincident. And so a lot of the data that we see in the news, these are lagging indicators. Okay, so like GDP growth numbers, unemployment data, those are lagging. It's the past. And then we have coincident indicators. I mean, that could be things like industrial production data, sales data, and so forth. So that's more in real time. And then the leading indicators, perhaps, are the most helpful. Well, the stock market is a terrific leading indicator because, as we like to say here in this office, it's a discounting mechanism, meaning that stock prices are taking in all available information, past, present, and a reasonable expectation of the near-term future. So near-term future is baked in, or in theory, baked into stock prices. We could also look at things like building permits and consumer expectations data as leading indicators. So that's kind of how we tie these together. And to your point, we could be in recession right now and not even know it because the data is backward looking. It's a lagging indicator. And stocks could be doing well during a recession because they're already looking past the recession to the recovery.
Yeah. You know, this kind of reminds me, now that you say that, I think back to the year 2000, you know, leading, and we had tech stocks just going crazy in 1998, 1999. You know, this was the
wasn't the world supposed to end back then?
2000. Yeah, I mean, like 97, 98, 99, the stock market was, there was a 5-year period where the S&P 500 compounded at 28%. And most of that was tech. And then we came the first quarter of 2000, the tech bubble burst. And then we had, you know, recession with that. But the stock market declined 3 years in a row. I think that the average tech stock lost 80% of its value. I mean, if you lose 50% of your value, you have to go up 100% to get back.
Mm-hmm.
I mean, imagine if you lose 80, you've got to go up, you know, 4 or 5 times just to get your money back.
I mean, the NASDAQ did eventually recover, but it took years.
Yes, it did. I mean, it took many years. I mean, the NASDAQ market went from, like, you know, 5,000 to 2,000. I mean, or I think it was over 5,000 and it went under 2,000. I mean, that's an enormous drop.
Right.
I think from like 5,000 to like 1,550 or something like that. But we're kind of seeing this, you know, because, you know, what to do with your money.
Well, let me just summarize, because we've talked about what a recession is. We've talked about why they occur, indicators that are commonly used. And I guess the next question is, well, we also talked about the role of the Fed in all of this. But so the next question would be, what does well from an investment standpoint if we're going into recession? What should people be doing differently with their money if they're not already?
No, that's a good question. Well, if you believe that, you could say all the hype right now is about artificial intelligence or tech stocks associated with AI. And if you think about that, the story was, so these are high PE tech or growthy names. And a lot of people, especially fans of those names, would argue that regardless of whether we're in recession or not, a lot of growth companies are going to have earnings in a recessionary period whether we're in recession or not. So something like,
that's key. Earnings.
yeah, so that's very key. So then, and in contrast to that, you would have cyclical stocks, companies that have strong earnings when the economy is strong, and conversely, earnings decline, a decline in earnings when we go into recessionary periods. And with those, names like that would be like, say, Delta Airlines or Ford Motor Company, some financials, some of those things. But and then to your point, so what would you want to own if we're heading into recession? First off, to even try to pinpoint exactly when this is, there's problems with that, because I mean, if you add up, if we try to figure out when we're going to have recession, and then if we're going to have recession, and then when is it occurring,
and how severe,
and the probability of all these factors, by the time you multiply all this out, it seems like
throwing darts.
It's throwing darts. So you'd want to own what we call defensives, not to be confused with the defense industry like Lockheed Martin or Raytheon or something like that. But defensives, Wesley, do you know what a defensive is?
It's the people on the other side of the wall.
That's good. It would be like,
now in sports,
it would be grocers, Kroger's,
Band-Aids,
pharmaceuticals. There you go.
I think a simple way,
tobacco and alcohol.
Yeah, simple way to describe
healthcare
is even in an economic decline, there are things that people will buy, regardless of what's going on in the economy. Staples. Okay, people have to eat.
Right.
You've got to buy gasoline for the car. People are going to pay for their health insurance. I mean, there are things that people will continue to do. But there are also things that they won't do, that they will cut out. To your point, travel, entertainment, things that are not necessary.
Luxury.
Yeah.
Yeah.
So those types of, we can say, consumer staples, those types of investments tend to hold up because people will spend money on those things regardless.
That brings up another aspect or way to look at the question that you posed too, Bill. So you would, or under most circumstances, you would want to own more in fixed income.
Yeah.
Or even historically, you would want to own long dated fixed income. Now, because
now we're talking about the asset class.
Yes, we're talking about what to do with your money if you think that we're headed to recession.
So bonds historically tend to fare better than stocks in a recession.
Yeah. We're getting ready to do a seminar about optimizing portfolios and talking about efficient ways to construct portfolios. And it's interesting. You don't want all of your all the different slices of the pie or securities moving in the same direction at the same time. And so historically, like typically when the stock market has a bad day or a bad season, and call it during a recessionary time, stocks decline and generally bond prices go up. So when you have a flight to quality, people sell risk assets. That's called risk off. And then they buy high quality bonds.
High quality.
And so the highest quality bonds, like the U.S. Treasury, so they would be there's inverse correlation there between stocks and bonds. But
within the bond space, though, you see a movement out of junkier bonds. So those issuers of bonds that are less creditworthy are more at risk of defaulting on their bond obligations because of economic distress. And so we see this gap widen out, this yield spread gap between the yields that you can get on risk-free treasuries and yields on junk bonds. So that means prices on junk bonds are plummeting, driving up the yields because you have to be compensated for taking that credit risk.
And a something to reflect upon is during the great financial crisis, or the subprime crisis, some people called it, back in began late 07, 08, 09.
Yeah, Wesley wasn't around then.
You had to own AA quality bonds or better, or you lost money.
Mm-hmm.
Now, if you own AAA rated bonds, you fared very well during that pretty strong stock market downturn. 2008, the stock market fell 37%. I don't remember, but the long dated high quality bond market earned double digit returns.
Okay.
But if you ventured into junkier stuff, you lost money, just not as badly as
Okay, so when we look at asset classes, we can say that bonds historically do better than stocks. And then within the bond asset category, high quality bonds do better than lower quality bonds. Now, if we go back to stocks, we talked about things like consumer staples, those sectors comprised of companies that sell things that people have to have.
right.
But earlier, you mentioned large tech, and I think that's another category. We could say quality companies that, are able to generate earnings in any kind of economic environment. And technology, these big tech companies have shown some immunity to that.
Yeah, I mean, I think if you think about, we could go down the list of these, like Meta.
Mm-hmm.
Are people now Meta? They derive their income from advertising revenues. I think. I could see. Is that recession proof? How about Tesla? These are these.
That's a discretionary, consumer discretionary company, and so
Meta.
No, Tesla.
Okay, Tesla
as an automotive company. So if we were in a deep recession, I would expect sales of all cars, including electric vehicles, to decline.
I completely agree. This brings me. I don't like the idea of owning many growth stocks, with the idea that we're heading into a recession. And I'm not saying that we are. It is highly probable.
Well,
I think these things are selling at 40 times earnings, and there is they've been driven by the hype.
Well, that's it.
So
these are, many of these companies, these mega capitalization tech companies, are very, very high quality. But the problem is, as you say, the prices have been bid up so high that it's hard to justify paying these high multiples, even though they would expectedly perform well in a recession.
So here's I've got a point to make, Bill, that I think goes with our whole conversation here.
Do it.
So these names on average are probably selling at 35 to 40 times earnings. That means that you pay $35 or $40 for every dollar per share that these companies.
And what's the historical average PE multiple on the S&P 500?
It's around like 15.
There you go.
So you're paying 2 or 3 times as much for earnings. Now, here's a couple of names that are up sharply today. Delta Airlines. Delta Airlines is selling at like 5 times next year's earnings. Ford Motor Company, it's up. Delta's up 3% today. Ford's up 2% today. Ford is selling at a single digit PE multiple. Now, those two names are cyclical names that would likely have decline in earnings if we enter into a recession. Yet, you said earlier that the stock market is a leading indicator. It's a discounting mechanism. So to some degree, I would argue that's already in the price. Would I want to own something that people are falling all over, because it's been deemed AI? Or would I rather own a Delta Airlines or a Ford, even fully aware that it's a high probability we're heading into a recession?
That's a good point. But when we talk about these earnings multiples, PE multiples, it's really not fair to compare, a Ford or Delta to, say, a Microsoft or an Apple, because if you're going to be comparing PE multiples, it's really more better to do it within an industry, because
absolutely.
there are industries where people are willing to pay higher multiples, and that will always be the case.
Well, if you're going to make money in them, a higher multiple requires a higher growth rate.
That's correct.
So it's all. I mean,
So the
that's
assumption is that you will get higher earnings in that higher PE
Exactly.
company than you will a lower PE.
yeah. A lot of people like to use this thing called a PEG ratio.
Mm-hmm.
So you take the PE ratio and divide it by the growth rate. And so if you have a PE of 10, for example, and you have a growth rate of 12, that's a PEG ratio that's less than 1, and you've got something that's pretty good.
Yeah,
Take
that's
the
a
growth
better
rate.
way to evaluate
Yeah.
across industries.
So, well, where do we go from here, William?
Well, the topic today was recession, because that's all over the news. It's been all over the news, and we could be in recession now. I think the point that we're trying to make to our viewers is it's not something that you should be agonizing over, and you should not be making radical changes to your investment portfolio. There are some things that you could be doing, if you're not already doing, that could help lessen volatility. And we hear this in bantered about, is this priced in? Because we're saying that these markets and prices of financial securities discount expectations, but there seems to be a divergence between the bond market's views and the stock market's views, and the bond market seems to be pricing in the probability of a recession more highly than the stock market is. Again, this is theoretical, but if we were going into recession, the stock market could be in tune for declines.
Yeah, Bill, I think if I could bring up another point that I think that goes with all this, we were discussing this briefly earlier in the week, because we're getting ready to start a seminar series, and in the last 10 years, the bond market has really been very unappealing until it got whacked so badly last year. We had a horrific bear market, if you will. Stock market was pretty bad last year, but the bond market, by historical standards, was much worse. So there was this 60-40 conservative portfolio that since 1926 has given one, I think, 8.1% per annum to be 60% in the S&P 500 or a broad basket of stocks, and 40% in the Barclays Aggregate Index, or intermediate term high quality bond market. But that that was with historical bond yields of around 5%, which for the last 10 years got all the way down to 1%. Well, given what's happened last year, the bond market is once again very much more appealing. 60-40 is no longer dead, and one way to look at these different asset classes is if you take, we've been discussing price to earnings ratios, but take the PE and invert it and look at the earnings yield. So if you have a company that is selling at a 20 PE, which is cut it with a meat axe, that's pretty much where the broad stock market is today. That means it has an earnings yield of 5%. Okay, an earnings yield of 5% is not terribly attractive, especially when you can compare that to a 1-year CD or a 1-year treasury that's paying 5.3% or something like that. And that's approximately where we are today.
Mhm.
So it makes sense, especially if you're nervous about the markets. We're just this week, Bill, we can tell our viewers that we've been buying a business development company that has an earnings yield of 8.8%. I don't think they've ever had a single bond in their portfolio fail. They're adjustable rate bonds, which means if interest rates go up, it earns more money because the individual loans in there made to mid-market America, their yields, their payments are tied to typically LIBOR plus a margin.
So you're protected from interest rate risk.
You're protected from interest rate risk, yet the yields on these are very attractive. If you compare the earnings yield of the S&P 500, call it somewhere between 5 and 6%, and we're owning things in fixed income, even some baby bonds that we own that have yields of 7 or 8%. That seems far more attractive than running after AI stocks to me. So, and the point of that is to have a very diversified, well-constructed portfolio that will protect you from excessive or undue harm in the event that things turn down.
Now,
should the economy
I
turn
just
down?
thought about this. In a recession, all right, what about real estate? Well, we would expect real estate investments to underperform.
Absolutely.
What about commodities? Well, it depends. Depends on the commodity. Historically, energy commodities tend to underperform because in a recession, people are not driving as much. So there's less demand for oil and gas.
Yes, I think as you say, it's, that's something about efficiently constructed portfolios too, is that we've learned historically that in really troubling, difficult times, the correlation coefficients run together. In other words, if stocks decline, low quality bonds are going to decline, commodities are going to decline, all these things decline. But there are some exceptions to that. And
what about gold?
Pardon?
Gold?
Gold is up about 10% this year, with the average commodity, down this year. So
during the credit crisis, gold did well.
Yeah, and I was thinking, things like CTAs, or what we call managed futures. Now that's, in really troubling times, those are inversely correlated because they're rules-based algorithm run programs, or you can buy these in mutual funds. And so anyway, we're kind of rambling here, but we don't think anyone should do, if we take a phone call, if someone says, hey, I think we're heading into recession, so will you get out of my stocks for me? That's just a terrible misunderstanding of where we are, because we don't just own stocks. We own stocks that we think are reasonably priced, alternatives in a number of different areas, and we have more exposure, to higher yielding fixed income, even high quality, higher yielding fixed income.
Oh, that's a great point.
So
you never want to just jump out.
Yeah,
because
exactly.
When do you get back in?
Exactly. I'm committed to this thing for the long haul. At age 62, I'm not ever going to get out.
I thought you were 66. Sorry.
Okay. Well, hey, do you realize in an hour and a half, the LSU Tigers are taking the field? So to wrap this up with sports, Bill, do you know who LSU's playing today?
Well, you just gave it away.
What?
You gave it away that we're recording this episode.
What?
Well, yeah, that's okay. That's all right. We are recording this. This is not an actual live broadcast. Sorry, but
Okay. Oh, I'm sorry. Well, you didn't have to tell them. Some people
It's
wouldn't
all right.
know
I had
that.
fun with that.
But anyway, who's LSU playing today? Do you know?
I haven't even looked.
The
No.
Green Wave.
Oh, yeah.
Okay, LSU. The SEC had. There are 16 regionals that begin, I think, at 2:00 today. Maybe that's the second game. Each regional has 4 teams in it. Then the winner of those 4 teams moves on to a super regional and takes on a best 2 out of 3. The SEC is hosting 8 of the 16 regionals, and then they have 2 more SEC teams that are not a 1 seed or a host. And LSU got the 5th seed. They were number 1 most of the season and kind of faltered at the end. But the Green Wave, Tulane actually won their conference. They won their conference tournament, which propelled them into a regional. They're only 19-40 on the year, Bill. And so I hope that the Tigers dispatch them rather
I hope so too.
quickly.
It was a little disappointing how LSU played in the SEC tournament, but they still got to host a regional anyway. They've got superstars, but they don't have much depth on their pitching staff.
They're actually they have a player named Dylan Cruz who's supposed to be the first pick in the majors. He batted over 400 in the SEC, and I think 420 something overall on the year. And he's supposed to go number 1. And LSU has a starting pitcher that's supposed to go number 2. Now they, as you just concluded, if you can get LSU into their bullpen, you might have a chance. Yeah. And hopefully that's.
I think Wesley has a question about baseball, or maybe he's telling us to wrap it up. I don't know.
Have you guys seen my baseball?
That must mean he wants us to wrap it up.
Okay. Don't miss the LSU game today. Go Tigers. And thank you for watching.